And now, as part of Retire Meet 2021, Tom Cock presents The Science of Retirement Income.
Thank you, Don. Great work as always. And thank you for raising the one question that we get very often, and that is, what do I do with my money now? That's the number one reason you call me. It's pretty fascinating. And number two, the other thing that we get from most people that call us is, do I have enough to retire? Do I have enough money? And I always say, sure, but will it last for your lifetime? That's another question that you need to raise, right? So why do we call this science? I guess that's where at the beginning, why do we call this the science of retirement income? Well, science is systematic methodology based on evidence. These aren't suppositions. These aren't things that people sort of come ideas. This is work by academics that goes back decades, all the work that Don just showed you as well. So we trust this, and in a way that we think we can base it on evidence. Now, the future is always going to be different than the past, and we've certainly seen that the last year. So that's something to keep in mind. And before we get started, let's talk, first of all, I hope that some of you are regular listeners to Talking Real Money, which is, as those of you in the Seattle area know, on Como Radio every Saturday at noon, and available as a podcast, either going through talkingrealmoney.com or everywhere podcasts are available. Most of the future about retirement income is unknown because someone very famously said a few years ago that the only rate of return we'll really know about our portfolio, the rate of withdrawal, the correct withdrawal rate rather, is after we're gone. Well, then we can say, well, sure, I did it right or I didn't do it right. That's the only certain thing we know. But here are a few things also I think you could pay attention to. Number one, in a general sense, and I know life expectancy went down in the United States last year, but in a general sense, we are living longer, certainly from decades ago, certainly when Social Security was set up, for example, in the mid-1930s. And speaking of the mid-1930s, if you based your inflation on what it's been like since the 1930s, it runs at about 3%. Today, much lower, right? Last year, inflation was a little over 2%. So inflation is low, but it's not dead. And there's a lot of suggestion with increased government spending. And when we come out of this COVID crisis, that people are going to be running off and spending their money and sending inflation up. So inflation is something to pay attention to in your portfolio, especially when it comes to your investments, because it's an interesting numbers that we just looked at since 2008. Had you just taken all of your money out of the market in 2008 and put it in a bank account, you would have made a little over 0.5% per year. 0.5% per year. Had you put it all in a bond portfolio, you made a little over 4% a year. Had you had the correct asset allocation, had some in stocks made about 12% a year, 12, 4, and half of 1%. Those are important numbers to keep in mind. So inflation is something you've got to pay attention to with your retirement portfolio. And then the other part of retirement, sadly, for most of us now, is it's really up to us. It's only about 10% of Americans who have a private pension that they can rely on. And that's not very many, right? So the reality is you got to save. That's part one. People always want to talk about investing. And I say, you got to set money aside, especially those younger people. By the way, if you've got kids and grandkids who are starting jobs, that is a great time for them to automatically start setting aside 15 or 20%. The money's gone. I really urge people just to get that started at a young age. But then you get to retirement and you're going to live off your money. This is the fun part, right? You've had to scrimp, you've had to save, you've had to invest, you had to do all that. Now I'm at this moment and I've got to put together a plan for the balance of my retirement. And by the way, our planning software looks at your life for men to 92, for women to 94. And it's a long time if you retire in your mid 60s, or some people retiring earlier than that. Sadly, in this last year, a lot of people that accepted a voluntary layoff, for example, and are retiring at 60. That's a very long retirement. So you need to pay attention to the fact that your costs are going to go up. And the spending part of this, the budget, the spending plan. I try not to call it a budget because everybody shuts down if I use that word. You've heard some of these things before about the go years, right? The slow go years and the no-go years, right? Go right after you retire, hopefully in this next year or so too, when things open up again and you're running off enjoying your retirement. Then you get into your mid 70s, early 80s maybe, and you're going slower, right? Because It doesn't feel as good to get on a plane and run off to Mexico, even though it might be warm. It's a headache to get there. And then at the end of your life, they call it the no-go years, because you're not going anywhere, but you're spending oftentimes more money, especially on healthcare. And when we work with people, the first thing we're going to want to know is how much you're spending today and how much you're spending into the future. Now, I've had to look at this more carefully in the last few years. And I think, by the way, anyone over the age of 50 should have a plan for retirement. 50, and that's one of the things RetireMap could do for you right now, is to say, here's where you are, here's where you're trying to get to. It does a great job of that. But anyone over 50, I've looked, by the way, at my cost of living, which I had just taken what I'm spending today and then said, add inflation through my retirement. That's not quite accurate, because I'm not going to be paying into my 401k anymore. I have a daughter that has a private school education. I'm not going to be paying for that. My mortgage cost will actually be lower. So there's some factors to look at. And I look at this in sort of two buckets when it comes to the spending side. The things you have to have, right? You got to keep the lights on. You got to pay the rent. You got to pay the heat, hopefully wherever you are. All those things, right? And then there's the fun part, the vacations, the giving away, the helping others. So there's sort of two parts. And actually, in our planning software, we look at a number of factors. So there's all those sort of utilities, all that stuff. Then there's also mortgage separately and healthcare separately, because remember, healthcare has gone up about 6% a year versus regular inflation at 3%. So several buckets to look at, but this is something that is incredibly important. Every person needs to know what they're spending today and what they anticipate spending in retirement. The spend is a huge factor in all of this that oftentimes gets overlooked, because people want to dive right into the investing part, right? The savings that I'm showing you here on the screen. By the way, my presentation, there are a few printouts, and some of the numbers that I'm going to touch on here in a few minutes, it might make sense at some point to print those out so you have a better access to it, but they will be here on the screen. Looking at the sources of income in retirement: Social Security, pension, work. I thought we're talking about retirement. You're going to make me work again, Tom, and then your savings. So let me touch on each one of these. By the way, I hope you listened to Jason's talk on Social Security, because Social Security is overlooked. Social Security claiming strategies are most of the time done improperly. Let me give you a few numbers. It's about 1/3 of retirees now in the United States get all of their income from Social Security, 1/3. So how important is that decision around claiming? Hugely important. And 70% of the people that took Social Security last year in 2020 took it before full retirement age, 70%. And so those are lousy numbers for people. First of all, you don't want to be just relying on Social Security, but if you are primarily, you really got to get it right. And we know waiting, get a bigger amount from the government, correct? Every year, about 8% a year increase. So that is a huge number, plus inflation, by the way. So it's not a small consideration. And if you're married, if you're the higher wage earner, there's pretty good reasons for you to want to wait until age 70 to take it, instead of just jumping in at 62 or even full retirement age. Remember, your spouse then will be eligible for either her own or his own benefit, or half of yours. This is not something to be trifled with. This is something to look at extremely carefully. Social Security, a huge part of retirement, and I don't think it gets the attention it deserves and should. Then for those of you lucky enough to have a pension or a lump sum buyout, a lot of this came up last year because people, again, were sort of asked to leave, if you will, work early. And by the way, most of the time, the VLO itself did not tilt the balance one way or the other. But what did was, when do I take my pension, and should I take a lump sum, or should instead I get the annuity payout? For me, the trade-off between the lump sum and the annuity payout is a difficult one, for the following reasons. Number one, some of you are just not built for taking the risk of the market, of the ups and downs that are happening every day. And those people, I tell, then just take the annuity payout, remembering that the money is the company's, remembering that you're probably not getting a cost of living increase. So you're sort of stuck on that number. And in 25 years or so, it's going to be paying out about, in terms of real dollars, about half of what you would expect it to be paying out today. So that is a truly big deal, lump sum or annuity payout. Remember, when you get the lump sum and you invest it properly over time, the money's yours, and the expectation would be you end up paying yourself a little bit more, and you leave a larger amount to others. Those are the trade-offs involved in the pension situation. And then work. And again, I know people laugh at me when I bring this up because they say, I'm quitting. Why are you telling me to go back to work? Here's circumstances I think oftentimes make sense, especially if you retire in your early 60s, because here you are, you've got this period before Medicare at age 65. And Kevin, by the way, does a great talk on Medicare, which I hope you will take advantage of here in a little bit. But sometimes you need to provide that health care, which if you go out on the economy and try to get it, it's extremely expensive, right? Here's an idea. Maybe you could go to work part-time. I'm not trying to turn you into a barista or a greeter at Walmart, but a lot of those part-time jobs offer health benefits. So it's worth considering. Remembering also, by the way, in terms of work, that provides some income. So you can, again, wait on Social Security and wait on the other part of all this, which is very important. And that is your savings, which is the thing people call me all the time about. You want to know, I just came into $300,000 how to invest. The gentleman earlier today, I reduced my asset allocation, my risk profile, because I'm nervous about the future. And I'm trying to decide what I should do now. That's always the operative question, right? Well, you shouldn't start with that, first of all, which we're trying to make clear today, right? There should be all these other factors and then the asset allocation. That's part one. You've got to have the right construction in your portfolio. And what I'm talking about here is anything you have in stocks should be diversified the way that Don just shared with you, right? It should have big companies and small, growth and value, whatever percentage is in stocks, it should hold all of those asset classes. It should hold them at a very low cost. And you should not be trying to time in and out of markets depending on all the things going on in the world. And there's a lot of them, right? Whether it's COVID, whether it's a new administration, whether what's going on with the economy. I just read an amazing piece in Bloomberg on Apple. All those things are factors, but your asset allocation is about you. It has nothing to do with everything going on in the background because the background is always there. You're building yours for the rate of return you're trying to get and the volatility you're willing to accept to get that and how soon you need the money. And there's another part of the savings part. Oftentimes people call and say, I'm going to use it in 3 or 4 years. And I say, then put it in a very safe U.S. government bond fund, for example. I would not be running out and buying stocks if I needed money within 5 years. By the way, we should have mentioned, someone asked about exchange traded funds. We believe in exchange traded funds and we use them. We believe in mutual funds. We do not believe in individual stocks nor individual bonds. Too much risk with all those. Don mentioned Enron. There's 100 other examples we could go into. Certainly the trading in GameStop and AMC and all that sort of thing is something we do not advise for you as you near retirement, for anyone really, even young people, we think should just be globally diversified. So the savings part, okay? And how do we put all this together? Well, how do I get the income? I've saved $1 million. How do I create the money I'm going to need to pay the bills every single month? And I'm going to move on to the annuity part here because this is always a changing field. This is an area that people like because it feels safe. I give my money to someone, they pay me back a certain amount. Money never goes away, right? It's always there. I'm getting paid, et cetera, et cetera. Again, it's a trade-off. You're giving up the money. You're paying a lot, probably in most cases, to get that. And here's the part that drives me crazy. Anything other than an immediate annuity where you're giving it to an insurance company, they're paying you back your money plus a small interest. Any of the other ones, I do not recommend. Variable annuities, fixed index annuities, equity indexed annuities, registered index. I mean, there's all these names. They're all different too, by the way, and they're all confusing. And so we do not use, nor do we recommend annuities for our clients. That said, again, if you were in a situation where you had a budget and you said, I want to just pay the bills out of this bunch of money, you could buy an immediate annuity. We just looked this up. At 63 years old, you put $100,000 in your with no benefit at the end, you're going to get about $450 a month. If there's still money to be left over at the end of your life, you get about $400 a month. So it's not a lot, but it might provide some security, and that might be a way to provide income to pay the bills every day, and then have another bucket, if you will, to pay for the fund stuff. Then there's this withdrawal rate. You hear all the banter. Oh, by the way, before I forget, I do want to touch one more on equity index annuities, because they are the annuity of the day. They have other names, but they are certainly the hot one today. Luckily for us, another independent source just this week, John Reckenthaler from Morningstar, wrote a great piece about equity index annuities, calling them a simple concept, but the execution anything but. In other words, this sounds great. I get a part of the market and it's easy. I'm going to get my money, but every one of these annuities is designed differently. That's one thing. Reckenthaler also said, the only trust you can place in them is in that insurer. You have to believe in what they're telling you, because to get into the nuts and bolts of them is almost impossible. In his words, the list of drawbacks is depressingly long. And a quote from him, why would anyone buy such investments? I think that's pretty powerful, but here's the one that really drives me nuts, is when people say, instead of using US government bonds, I'll use an equity index annuity. Now, who do you trust to give you your money back? The US government or an insurance company that has built some fancy insurance product that is designed to pay you market-like returns over time? I don't buy it. I don't think you should either, by the way. And as Don just mentioned a couple minutes ago, the right balance is the key. The balance, by the way, between stocks, the riskier things, right? Equity in firms versus bonds. And in our case, we're going to use US government bonds to give you the balance in the portfolio. So a reasonable withdrawal rate depends on your situation. Is the 4% withdrawal rate that you hear about dead? No, I do not think so. And we'll show you some numbers. We're going to show you two examples. One is a 4% fixed coming out of your portfolio. The other is a 5% variable when we get to that page, which will come up just a moment here. But again, this all starts with having a plan. How do you create the income from those portfolios? Well, here's what I think makes sense, because people all the time tell me, well, I'll just take the dividends, I'll take the interest, I'll put it together that way. I think the better approach, frankly, is rebalancing. So you have built a portfolio 60% in stocks, 40% in bonds, just for sake of argument, okay? Because that's kind of the moderate everyman portfolio. And then part goes up, part maybe goes down. And by the way, last spring is a great example, because the bond fund, one of the bond funds that we use, the DFA Intermediate Term Government Bond Fund, was up about 10% by the end of March, where at the same time, as you may remember, stocks had gone down dramatically, over 20%. So now our portfolio is out of balance. So we sold bonds and we bought stocks. Sold the things that had gone up, bought the things that went down, and set in that transaction, set aside cash for people that needed to withdraw the money. Perfect example. By the way, we weren't smarter than anybody else. This is simply a disciplined approach that I think everyone should use when it comes to their money. Discipline, because once you have the plan, you have to have the discipline to stay with it. So this is something that's done with calculations done regularly when you hire us, but on your own, I think an annual calculation is good enough. And then again, how do you design this to pay yourself? Well, for tax reasons, it most of the time makes sense to use the money in the following order. Taxable accounts like brokerage, because there you're only going to pay long-term capital in the long-term capital gains tax, right? 15% in most instances, versus if you take money out of your qualified account, your IRA or your 401k, you're going to be paying income tax rate. Or the last place, let it grow as long as you can, would be Roth IRA, because the Roth grows tax-free. Taxable, qualified Roth. By the way, people call us clients from time to time and say, well, I need 200 grand. Can you just take it out of my IRA? And we say, well, no, because you still have 150,000 in your taxable account, and we'll wait as long as we have to take money out of the qualified, where we're going to have to pay tax on it. Taxable qualified Roth, I think for most of us, makes the most sense. So let's talk about a few numbers here, which I think are very important. We're going to show you two strategies. There are hundreds, and our clients do, every one of them does this. We do this for them on different schedules, different amounts. Some people only take the required minimum distribution. Some people take a fixed amount. And by the way, the fixed withdrawal strategy, if you've printed this out, should have a 4% above it, 4% a year. So here we are, going back 32 years to 1988, which interestingly enough was about the time that Don and I started working together. But you retired in 1988. You had $1 million, a lot of money then, a lot of money today, but certainly more then. And you're committed to taking out 4% of the portfolio, plus increasing it every year for inflation. And what we're trying to show you here is what happens as a result. Each one of these columns represents a portfolio. And some of you are going to tell us, I'm retired. I don't want to take any risk. I want it all in bonds. I don't want to mess around with it. I don't trust the market. I don't trust the economy, et cetera, et cetera. So we're showing you on the far left column, 100% in bonds. At the end of 1988, your $1 million is $1,010,000. But you can see here, by taking no risk, by the year 2020, your portfolio is down to less than $500,000. So it's a little nerve-wracking to see half of it go away, but you felt very safe about it, right? And you can see your distribution there at the end was 88,000. Slide all the way over to the right. Each column, though, represents an increase in risk. The next portfolio is 20% in stocks, 80% in bonds. I'd call that pretty conservative. It's a portfolio I had my mother in before she passed away in her mid-80s. But you can see at the end, you ended up with $1.5 million instead of $500,000. Work your way over. The next column, 40% in stocks, 60% in bonds. Again, it's pretty risk averse. And then, by the way, the one thing to consider with these portfolios today is the bond portion is paying, somewhere between 1 and 1.5%. That's your ballast. That's your stability. By the way, here's another way to look at the bonds in this portfolio. Let's say that you are 40% in stock, 60% in bonds, 600,000 in bonds. You could draw on that for a very long time from the bonds if the stock market had a difficult time. In other words, you have a lot of money to pull out no matter what stocks do. The 60-40, again, what we're trying to show you here is a couple of things. First of all, look at what you ended up with, $5.8 million. Your friends, or pardon me, your family, your charity, they all love you. You end up leaving a lot of money to others if that's important to you. By the way, I did this class many years ago, and I showed people this large number at the end of their life. And one guy stood up in the back and said, "No, Tom, I want the last check I write to bounce." That's too bad joke. Sorry, Don. So anyway, here we are. The trade-offs, right? In the case of the bonds, you took no risk. You ended up leaving less. In the case of 60-40, you paid yourself well, $88,000 your last year. You ended up with a little bit more for others. Trade-offs, important things to know. By the way, the design of this portfolio for you would include how much money you need, how much risk you are willing to take, and how long you need it to last. I think those are the factors that we're going to look at in Retire Map, for example, which are very important. That's one strategy. Here's another idea. You live with a variable amount, or by the way, you could use the 4% fixed for the bills you got to pay every day, and you take other money and put it into a flexible withdrawal. And so above the flexible should be 5%. We're taking 5% out of the portfolio every year, depending on the value, right? So you have a great year, everybody goes to Hawaii. You have a bad year, everybody goes to the local water park, right? You don't get to go anywhere. It's not as much fun. But look at the trade-offs here, which I find fascinating. In the 60-40 portfolio, the distribution the last year, $147,000. Wow, that's way more than the $88,000 you had in the last example, right? And the 60-40, you only end up leaving $2.9 million. Again, these are the things you need to decide what's important to you around leaving money to others or spending it all. Because we have people all the time who don't want to spend it. They've been savers, they've been investors their whole life, and it's hard to turn that spigot and go the other direction. I'm always telling our clients, spend your money. You saved it, you invested it, you made it. Enjoy it. But in this case, you enjoyed it more, right? Because your distributions were larger, but you left less to others. And by the way, you can see with the all bond portfolio here, you ended up with far more than you did in the 4% fixed. Trade-offs. Each one of these is a trade-off. The idea here, two things. Number one, part one, as you can see, when people say the 4% is dead, well, it hasn't been dead. It's worked for a long period of time. Will it work into the future? Well, nobody knows that. And especially in a period of time when bond payouts are very, very low. And number two, this is never fixed in stone. You could wake up tomorrow and say, I want to take more, I want to take less. People think, can I get my money back? Well, we only think you should ever invest in something that you can always get your money back in a few days. Never put it into something that's illiquid. And your life is going to change along the way, right? Things are going to come up that are going to make life different, and you need to adjust for that. Those are a couple of examples of retirement income. Let me give you a few of the nuts and bolts. Required minimum distributions. As you may know, the law's changed, and now you do not have to take your money out until age 72. Last year, there were no RMDs. Everybody's back in there again. We got to do it again this year. That's number one. It used to be 70 and a half, now it's 72. Number two, stretch IRAs. You can put a line right through that. They're really gone now. The idea that you leave money to your heirs and they get to take it out over their lifetime, that has been X'd. They have to take it out in 10 years now. Now, you could do it evenly each year. You could do a little bit one year, you could adjust it each year depending on your tax, or you could wait till the 10th year and take it all out. Have a lot of strategies there. Here's another mistake I see people make. Proper titling and beneficiaries. You do not want to leave the money to your deceased parents. You do not want to leave it to your ex-wife. No offense to your ex-wife, unless that's something you really want to do. Make sure your beneficiaries are set up correctly. It's nothing to mess around with. And here are a few more of the mistakes that I see as a practitioner. And by the way, I didn't get to say this at the beginning. Thank you for believing in us. Thank you for coming today. And to our clients who are watching, thank you for trusting us all these years and knowing that we're putting your interest ahead of ours, and we truly do care about you. So it's very much a two-way street, and it's given my life great enrichment I never would have expected. But here are a few of the mistakes. Number one, people have a tendency to get to retirement and do not know what rate of spending they need. In other words, they kind of just start and say, I'll take 50 this year, 60. That you got to have a plan, right? Brings me to number two. They have a bad withdrawal rate. They start taking out 6% or 7% with all in bonds. They do not know the risk they're taking of running out of the money. Number three, taking too little risk. $18 trillion today is in banks that is paying almost nothing. So you either love those banks or you're inefficient. Your portfolio should be designed for you, your need for growth, your ability to see volatility up and down, and how soon you need the money. Nothing else should be a factor in your asset allocation, which brings me to the next one, taking too much risk. You should not, with your retirement accounts, be trading. You should not be buying high risk instruments. You're hoping to make more. There's another mistake I see, especially in a low interest rate environment, because people are pitching stuff all over the place about here's how to make money with no risk. Risk and return are linked. There is no way around it. And that brings me to the last one right here. And that is, we do not believe in expensive annuities. Any product other than an immediate annuity is probably great for the insurance company, not so great for the people that are buying it. How do you fix all this? If you're swinging around a little bit, you don't know what your asset allocation, you don't know what your spend rate is in retirement, whether you are retired or not, and whether or not you work with an advisor or not. Everybody's got to have a plan. Again, and today I forgot, think about the code. Thank you for reminding me, Don, that for $99, you get a look at your retirement income, all the sources. Will it last? Number two, we analyze your portfolio to see how diversified you are, how much risk you're taking, how much you're paying others. And you get this great book that Larry Swedroe and Kevin Grogan wrote, truly encyclopedic look at all things retirement. Somebody asked us earlier about reverse mortgages. I think it's wonderful, a book, because you could go to any page and read it. You don't have to read it cover to cover. I did on a vacation once, got in trouble because my wife accused me of working during the vacation. But I think it's such a great book. And again, you get that with the Retire Map. You go to back to Retire Meet and click on Retire Map. And by the way, the special code is only available today. The offer is only available today. So you got to take advantage of all that. And you give us a little bit of information when we get started. We work with people all over the country, and basically in every state. So there's no issue there if you're located somewhere outside of the great state of Washington or elsewhere. I do want to mention my three takeaways again. Number one, you got to have a plan. You got to know what you're trying to do. Number two, whatever your discipline is, you got to stay with it. You can't change because the world has changed. Number three, even if you're a do-it-yourselfer, even if you're somebody who's highly confident in your portfolio and the design of your retirement income, you should have a professional review. Here's a great opportunity for only $99 to do so. Take advantage of all that. Don, I know we're down to like a minute and a half, and I'm glad this worked out the way it did. But are there any questions you want to share with us?
Well, you really, okay, here's one. Can you explain your definition of 4% fixed used for retirement income? And also, can you talk more about the variable withdrawal strategy? How did you get to 5%?
So the 4% fix simply means that if you start with, and we showed you an example, $1 million, the first year you're taking out 40, the next year you're adding in for inflation. So that number is going up over time due to the fact that the costs rise. The 5%, how did we arrive at that? Well, we're trying to tilt the meter for those of you who want to be bigger spenders. And by the way, I'm planning on, with the sort of fund money in my portfolio, to have a flexible withdrawal that allows me to take out more in the good years and less in the not so good years. So that the 5 is a random number. You could turn the dial up higher if you wanted. Oftentimes that's where it ends up breaking.